Well, Starbucks says it is closing underperforming stores across North America.
Adding that it will lay off some 900 non-retail employees.
I'm surprised and disappointed.
It seems store sales have been negative for 6 straight quarters, and CEO Brian Niccol has just surpassed the 1-year mark in that role. This is the second round of layoffs under Niccol.
This is a neighborhood spot, so it's kind of sad that they're closing.
Something unprecedented just occurred across the Canadian commercial landscape, and most people interpreted it as a simple business decision. Starbucks, a corporation operating nearly 38,000 locations worldwide and annual revenues exceeding $36 billion, initiated closures across Canada at a scale that defies normal market correction logic. We're not discussing a handful of underperforming outlets. Nearly 200 Canadian stores, roughly 17% of the entire national footprint, were marked for elimination or have already shuttered. When a multinational of this magnitude executes cuts this deep in a stable Western market, the action itself becomes evidence. Evidence that the commercial environment has fundamentally shifted in ways most observers haven't recognized yet. The closures concentrated in Canada's primary economic centers. Downtown Toronto saw over 24 locations either close or announce final operating dates. Vancouver, Calgary, and Edmonton followed similar patterns. These weren't marginal locations in declining neighborhoods. Many occupied premium real estate in high-traffic corridors that had functioned profitably for years. The company framed this as restructuring, as operational optimization. But when you examine the timing, the geography, and the corporate communications surrounding these decisions, a different picture emerges. Starbucks isn't simply adjusting to temporary conditions. It's withdrawing from markets where the fundamental economics of retail operation have deteriorated past viability thresholds. For decades, North American retail operated on a predictable model. High-traffic urban cores generated consistent foot traffic. Morning commuters, office workers, weekend shoppers. These patterns created reliable revenue streams that justified premium lease costs and staffing expenses. Starbucks built its entire North American expansion strategy on this stability. Locations near transit hubs, in office tower lobbies, along major pedestrian corridors. Each store functioned as a daily revenue generator tied to predictable human movement. That predictability has collapsed. Remote work didn't just reduce foot traffic temporarily. It permanently restructured where people spend their time and money. Downtown cores that once saw 100,000 daily office workers now operate at 60 to 70% of pre-2019 levels in major Canadian cities. This isn't a transition period. This is the new baseline. The economic implications compound rapidly. Commercial real estate rates in downtown Toronto have surged 40% over the past 5 years. Vancouver's retail lease costs now rank among the highest in North America, frequently exceeding comparable rates in Seattle or Boston. When you're operating a location that requires $15,000 to $25,000 monthly in rent alone, the revenue threshold for profitability becomes extreme. You need consistent, high-volume traffic to justify those costs, and that traffic has vanished. Starbucks locations that once processed 400 to 500 transactions daily are now seeing 250 to 300. The mathematics stops working. Even for a corporation with Starbucks' scale and efficiency, you cannot operate profitably when fixed costs rise 40%, while customer volume drops 30%. The margin evaporates entirely. The competitive landscape shifted simultaneously. While Starbucks positioned itself as premium and aspirational, competitors repositioned around value and accessibility. Tim Hortons maintained its everyday pricing model, simpler menu, lower cost, ubiquitous presence. When economic conditions tighten, consumers default to familiar, affordable options. McDonald's McCafe expanded aggressively across Canada over the past 2 years, offering espresso-based drinks at price points 20-30% below Starbucks, while leveraging thousands of existing locations with drive-thrus and extended hours. Even independent coffee shops, which Starbucks once threatened with extinction, have experienced renewed customer loyalty as consumers seek authentic local experiences over transactional efficiency. Market data shows independent cafes gaining 12% in customer loyalty over the past 18 months. That represents a reversal that would have seemed impossible a decade ago. The timing matters critically here. Starbucks isn't just struggling in Canada. The company has posted 6 consecutive quarters of declining sales globally. It shuttered over 600 stores worldwide, eliminated nearly 1,000 corporate positions, and wrote off millions in restructuring costs just to stabilize operations. The most recent quarterly earnings revealed a 3% drop in same-store sales across North America, with operating margins compressed to levels not seen since the 2008 financial crisis. Canada didn't cause this crisis, but Canada became one of the first markets where Starbucks chose to downsize aggressively as part of emergency profitability protection. When a multinational corporation makes that calculation, it's announcing a hierarchy. Some markets matter strategically. Others can be sacrificed to preserve overall performance. Canada fell into the latter category. Now, consider the strategic redirection occurring simultaneously. While Starbucks contracts in Canada, it's expanding aggressively in India and China. The company recently formed a $4 billion joint venture with Chinese asset management firm Boyu Capital to operate locations in China, with Boyu holding up to 60% interest. These markets represent high growth potential, fierce competition, and long-term upside. When a corporation sees stronger returns abroad than in established Western markets, capital flows accordingly. Strategy shifts toward regions where momentum runs strongest. Canada becomes the market where footprint right-sizes rather than scales. That terminology matters. It signals that Canada is no longer viewed as a growth market. It's viewed as a market requiring optimization, corporate language for managed decline. The geopolitical dimension here operates quietly but significantly. When major multinationals begin treating Canada as a secondary market relative to Asian expansion, it reflects broader shifts in global commercial gravity. North American markets, particularly Canadian markets, are increasingly viewed through the lens of maturity and limitation, rather than opportunity and expansion. This isn't unique to Starbucks. Retail, technology, and consumer goods companies across sectors are recalibrating their North American strategies while prioritizing Asian and emerging markets. The commercial relationship between the United States and Canada, which operated for decades on assumptions of shared prosperity and integrated markets, is fragmenting along new lines. Companies now optimize for profitability and growth potential rather than geographic proximity or historical integration. The consumer behavior underlying these closures reveals even deeper economic strain. Canadians aren't abandoning coffee. They're abandoning premium pricing during a period of compressed household budgets. Grocery store coffee sales jumped 18%, as consumers invested once in home equipment rather than repeatedly in daily cafe visits. Discount retailers are expanding while premium brands contract. Dollarama reports strong traffic. Budget chains are growing. Meanwhile, brands positioned as lifestyle or aspirational are facing sustained pressure. This represents a fundamental reordering of consumer priorities away from experience and toward value and necessity. When that shift occurs across an entire market, it doesn't reverse quickly. It becomes the new consumer baseline that companies must adapt to or exit. The broader North American commercial environment is experiencing similar pressures, though less visibly. United States markets haven't seen Starbucks closures at Canadian scale, but the same forces are building. Urban foot traffic remains below pre-2019 levels in most major cities. Remote work has permanently reduced office district activity. Consumer spending is increasingly price-sensitive as household budgets tighten under inflation, interest rate increases, and wage-price mismatches. Premium retail concepts that thrived in the 2010s are facing sustained pressure as consumers prioritize essential spending over discretionary experiences. The difference is that United States market size and diversity allows corporations more flexibility to optimize without triggering visible mass closures. Canada's smaller market meant optimization required more dramatic action. The question that should concern both American and Canadian audiences is what comes next. If premium retail cannot sustain itself in major Canadian urban markets, what does that signal about underlying economic health? If corporations are redirecting investment toward Asian markets while managing decline in North America, how does that reshape regional economic trajectory? If consumer behavior has shifted permanently toward value and away from experience, what does that mean for the thousands of businesses built on the opposite assumption? These aren't hypothetical questions. They're playing out in real time through closed storefronts, reduced investment, and strategic repositioning by some of the world's most sophisticated corporations. Starbucks will survive this contraction. It will optimize its remaining Canadian locations, focus on drive-through and suburban formats, and continue expanding in higher growth markets globally. But the Canadian urban retail environment that's being left behind won't recover quickly. Once foot traffic disappears, once commercial anchors close, once investment capital redirects elsewhere, rebuilding takes years or decades. The vacant storefronts appearing across Toronto, Vancouver, and Calgary aren't temporary. They're evidence of permanent structural change in how these cities function economically. And that change is accelerating, not reversing. The Starbucks withdrawal isn't about coffee. It's about commercial viability thresholds being crossed in North American markets that were supposed to be stable, prosperous, and growth-oriented. It's about corporations making cold calculations that some regions no longer justify the investment required to operate there. It's about economic fragmentation between markets that remain strategically important and those being quietly downgraded to maintenance status. And it's about the gap between official narratives of stability and the reality being revealed through corporate action. When the storefronts close faster than the explanations arrive, people stop listening to reassurances and start drawing their own conclusions. And those conclusions are being formed right now in every neighborhood, watching another familiar brand disappear from the corner where it used to be.